Good morning and welcome to your Tuesday, May 7th market news update. The Reserve Bank of Australia kept its policy rate unchanged for the fourth straight session at the 4.35% level. Traders carry on speculating that the yen will weaken further despite the government's intervention efforts. Israel rejected once again the ceasefire plans and instead mobilized troops into Rafah. Equity traders brace for Disney, Ferrari, UBS and Lyft earnings releases. Unemployment in Switzerland edged lower to the 2.3% level and pressed the CHF. Chinese stocks snapped their 10-day winning streaks today and detached from 8-month highs. Finally, WTI futures remain unmoved near the $78 per barrel level, despite another failure of ceasefire talks. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 7th of May of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now the first and sole topic of the day is going to be about RBA and its actual monetary policy decision result. So earlier today, the Reserve Bank of Australia decided to keep its current policy regime intact, pausing for the fourth consecutive session, and has left its overnight cash rate unchanged at the 4.35% level. Now, the Governing Council judged that inflation still poses a threat for the Australian economy, as the pace of easing of inflationary pressures back towards the target has slowed in the past quarter, which nudged policymakers to maintain this kind of cautious stance. The risk of inflation becoming deeply entrenched in the Australian economy has been the main concern for RBA officials for the past few meetings now, alongside the progress of the wage growth, but also the trajectory of the economic prosperity of the nation. Now, the central bank noted that it will closely monitor the global economy, the domestic trends, the labor market, but also the outlook of inflation before altering its stance towards looser financial conditions, and has highlighted that changes will be made depending on the potency of incoming data. So data dependency has been also the adopted path going forward for RBA as well. So nothing unsurprising here. So post the decision, the Australian dollar has faced pressure and has weakened against the United States dollar, has detached from a two-month high peak, and is currently attempting consolidation near the $0.66 per level. Okay, so the weakness may have stemmed from the fact that markets expected a hawkish commentary from RBA, not actual decision, but a hawkish commentary, given that inflation stays elevated, but the blow may have been softened by the somewhat diplomatic, we may say, wording found in the forward guidance in the accompanying statement, which noted that the committee, or we, are not ruling anything in or out going forward, referencing that the bank's policy decisions are ultimately going to depend on incoming data once again. Okay, so that is all for today's session, guys. It's been short and sweet. Thanks for watching, and we will catch you on to tomorrow's session for hopefully another brief update. For the time being, take care. Bye-bye.
Hi everyone and welcome to the earnings season section. And today we highlight the releases from Disney, Lyft and New Fortress Energy. Disney, the world-renowned entertainment company, not only produces and distributes films and online streaming content to viewers worldwide, but also operates theme parks and resorts under the Disneyland banner in many countries. Disney is the second largest company in the movies and entertainment industry according to market capitalization metrics. Analysts forecast Disney beat its earnings per share target by 19 cents, yet missed its revenue target by approximately minus $224 million in the first quarter of 2024. Point of interest will be the progress of the company's streaming business. Disney Plus subscription growth front and center for investors. Lyft operates multimodal transportation networks that offer riders personalized and on-demand access to various mobility options, such as ride-sharing, flexible car rentals, and a network of shared bikes and scooters in various locations worldwide, and holds the fifth position in the ground transportation industry, according to market capitalization. Analysts forecast a Lyft beat of both its earnings per share and revenue metrics in the first quarter of 2024 by 8 cents and $3.6 million respectively. Point of interest will be insights about how the company fares in its ride-sharing battle with its main competitor Uber. Solid ride-sharing growth could propel Lyft shares to higher ground. Finally, New Fortress Energy operates as an integrated gas-to-power energy infrastructure company that provides energy and development services to end users worldwide, and it is the 17th largest player in the oil and gas storage and transportation industry, according to market capitalization. Analysts forecasted New Fortress Energy beat of both its earnings per share and revenue metrics in the first quarter of 2024 by 19 cents and $100 million respectively. Point of interest will be the company's upcoming LNG project developments and the finalized details from the sale of the Puerto Rico power plants. Progress of New Fortress Energy's power plant construction in Brazil. That's all for now, and thank you for watching.
Hi everybody, welcome. I see people start to join in. That's perfect. Welcome Shiv, welcome Michael, welcome Adil. Hi Joshua. Hi Marie. Hi Maria. Okay. What else we have here? We have Giorgio. We have Ruslan. Hi everybody. Hope you are all having a lovely, lovely Friday. Okay. Give me a few moments, please. I think I have everything up and running correctly. Please give me a thumbs up whether you can see the first slide of the presentation, whether you can hear my voice. And again, it's irrelevant whether you can see me or not, but yeah, that's a plus. So you can actually type in the chat. That would be another check. Okay. Thanks for the confirmation, Adele. Hi, Michael. Welcome. Rocco. Okay, perfect. So, welcome, guys. We have what 43 people in here. Okay, that's good. We can do more. Let's give a few more seconds for our people to join, and let's do a small recap before we begin. So, as you may know, this is unfortunately the last episode of our series. Okay, we're gonna kickstart the whole thing after the end of this year. So in January of 2024, we're going to begin this series from the beginning once again. So this is going to be the final one. And today's topic will be about a broad topic, a topic that is not discussed as much, even though it's one of the most crucial aspects of trading that should be taught. Okay, so we're going to talk about risk management, and we're going to introduce all this kind of lovely stuff that revolve around proper risk management techniques, if you would like, that once applied in your trading journey, that could ensure, okay, you making more profits, having smaller losses, and at the end of the day, becoming a much more accurate and much more not sophisticated, that would be drawn from other kind of aspects of trading, but you're going to become much more accurate in entering and exiting position, becoming much more disciplined, okay, in following the plan and seeing your plan being carried out and going your way or not. If it doesn't go your way, you're going to have small losses. It happens, become accustomed to small losses, not losses in general, small losses, okay, taking those not lovely, but taking those damn losses, small losses, instead of going vaguely at trading without stop losses and, I don't know, having excessive damage to your portfolio. So there's no reason to do that. Apply these tools we're going to introduce today, and you're going to have much more confidence, or at least higher probabilities of staying in the game for a longer time, okay, which is key, okay? So I think we're gonna make a start. Okay, again, topic of the conversation today is going to be risk management techniques. And before we delve into the details, let me go over a quick risk warning and a disclaimer, and we'll be on our way. Okay, so the risk warning is our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. Now, these products may not be suitable for everyone, and that you should ensure that you understand all the risks involved. The disclaimer is the information in this webinar shall not be considered as investment advice or investment recommendation, but it is instead for educational purposes only. The material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. T4Trade is not responsible for any loss arising from any information contained herein, and the redistribution of the material is strictly prohibited. Okay, moving on. So we're going to make a start with what types of orders are out there and which ones shall benefit you the most, or at least introduce them, because there are quite a few different options when you can undertake a position. Okay, we're going to introduce the basic ones, the ones that are most widely used ones, and the ones that do not have that much hassle, if you will like. Okay, so types of orders. But before we go into the types, let's introduce or cover the definition of an order. Okay, so an order is practically, I know this is pretty easy stuff to understand, but we have to go through them. Okay, an order is practically the initiation or the termination of a trading position in a trading platform, much like MT4, MT5, whatever that might be, okay, for any given instrument. So opening and closing your positions, you can do that by placing orders. Okay, so it is the order to start or to stop trading, okay, practically for any given position. You could start by buying or either selling a trading instrument. That would be, in a sense, the initiation, okay, the start of a position, while its termination would be the closing or covering of an existing position, either that would be covered fully or partially, okay, same thing, termination of the position that have been opened previously, okay? So in a sense, to close a position, you must first open it. No need to tell you that, but still, okay? Orders are distinguished into two categories. We have this kind of broad distinction, okay? So it's irrespective of the direction, whether you are buying or selling, okay? And whether you are opening a position or closing it, but they depend on the time frame of their activation. You will see what I mean by this pretty shortly, okay? So you have what we call market orders, okay? So market orders are, in a sense, the orders that are initiated or terminated a specific position, okay, at an instant, okay? So if you click the buy button at the current whatever instrument you're looking at, for example, WTI, okay, if you press on the buy button, okay, or the sell button, whatever you want to choose, let's say we chose to click on the buy button, okay, you will get an instant execution. Okay, this is the key distinction between the other type of orders, which is pending orders. Okay, so it's a direct order to start trading in the market at the current rate that the market is currently fluctuating around, okay, of that specific instrument. The main characteristic is that you enter or close a position immediately, okay? In other words, you simply trade an instrument on the current market price within the push of a button at the current point in time, okay? So this is the reason why I'm emphasizing on the immediately and the current point in time is because this is the main distinction between pending orders, and the other one is obviously the price, okay? So on the flip side, you have pending orders, the second category, if you would like, okay? Which the brief distinction or the small distinction that it has with market orders is that these orders are not immediate. What do we mean by immediate? Okay, they need a certain condition that needs to be met in order to be activated. For example, a pending order will be set, okay, in the trading platform, okay, to start buying, for example, an FX pair, Euro USD, once the particular instrument reaches a certain price that you predetermined, okay? This is the whole point, okay? Or let's take out of the equation the Euro USD and let's do, once again, WTI for the point of convenience, nothing else, okay? Currently, the market price, for example, of crude might be revolving, I'm not sure. I'm assuming it's still at the $80 per barrel range, okay? 70, excuse me. And for example, if you want to place a market order, you just click on the button and you get an instant execution, maybe 70.10, whatever that might be, $70.10. For example, on the flip side, if you want to place a pending order, which is a little bit much more accurate in regards to you being much more sensitive to price, you would like to enter the position of crude once it reaches the $72.30, okay? Your market order, your pending order will not be executed, okay, at this point in time, and it will be executed if and only if the price reaches that specific level, okay? If it does not reach that level and it goes to 72.29, you will not get an execution, okay? This is the main distinction between market orders and pending orders, okay? So the time parameter is also in play, but also the accuracy of you entering the position is predetermined in pending orders, and you quote unquote guaranteed to get that price you have selected previously when you opted for a pending order instead of a market order. Okay, so this is the main distinction between the two types of orders. Okay, there are many other orders out there. We just focused our attention on the two main or broad kind of categories of them. Okay, market orders and pending orders. Okay, so this is pretty much it. Super simple stuff. Now we're going to discuss about take profit orders. Okay, what are take profit orders? Much like the name suggests. Okay, a take profit order is a type of a limit order, again, specifies the exact price at which the close is going to take place, okay? Or when you're going to cover your position, okay? If the price of the security of any given asset you are actually trading, okay, does not reach the limit price, which is by default the setting of the take profit order, the take profit order, the TP order will not get filled, okay? Again, making another imaginary scenario. You have currently, you want to trade WTI, you open a position with the market order. So you take the current available price that is in the market right now, whatever that might be, 70.42, whatever that is, okay? And you set your take profit order at the $75, okay? If and only if the price action reaches the $75, you will get the execution. If it goes to 74.99, you will not get an execution and you will not trigger the take profit, and therefore your position will stay open. Okay? This is the nature, okay, that take profit orders, and much like stop loss orders, are actually working. This is how they work. They are limit orders. Their specific price you have set, okay, you have predetermined when you first place that order, is in a sense the criteria that will validate whether you're going to be filled or not. Okay, so in a sense you can imagine, okay, take profit orders and stop loss orders as pending orders. Okay, this is pretty much it. Okay, now why do traders use them, which is a much more nuanced kind of question, is that most traders use take profit orders alongside stop loss orders to manage their open positions. Now, if the instrument price rises to the take profit level, the order is executed and the position is closed for a gain. Okay. On the flip side, if you place a short order, okay, if you place a long order and you have a stop loss, okay, set below that, obviously, and reaches that, your order will be pretty much closed if it reaches that specific level. Okay, pretty self-explanatory stuff. Now, let's do the example once again. Maybe that will enlighten us a little bit more. I don't think so, because we covered this. So let's assume you just place a long order on WTI crude at the $80 per barrel. So, old example, but still. Right after buying the commodity, you place a take profit order at the $84 level. If WTI rises above 84, your position will be terminated. In a sense, the trading platform or the software will automatically close your position. Okay, in a sense, sell your position in order to close it because you have already opened it at the prevailing market price, and you will realize, in a sense, a 5% gain, and you can do the calculation. $4 divided by 80 will give you 5%. So what are the advantages of using the take profit orders or stop loss orders? By that extent, you will see them on the next slide. It's easy to place and modify. Okay, super simple. Okay, this is one of the most important benefits of or advantages of placing take profit orders, in my estimation, which is the second point, which cures the itchy trigger finger syndrome. What does that even mean? Okay, you place a long order and you see the price action rising, meaning it's going your way and you're actually making money, and you have set a take profit order, taking this example we just had, at the $84 per barrel range. Okay, price rises to the $82, then goes on to the 83, and somewhere in there, because you get closer to there, you say, you know what, I'm making money, why not close the position now and just go ahead and do my other businesses? Okay, in a sense, this, by placing a take profit order, eliminates this kind of hassle you have in the back of your mind when to close the position. If you have made your assessment, given the current indications you have in regarding to whatever instrument you're looking at, and you have a solid case that, for example, WTI will move to higher ground, you use take profit orders for ease of
mind, okay, to cure this itchy trigger finger syndrome that you are actually glued to your screen and you are oh, you know what, it starts to fall now, I'm going to close the position and make as much money. No, use take profit orders in order to give more validation, but also more confidence in your scenario, okay, at matching its target, okay. So it cures, in a sense, that neurotic kind of looking at the charts and sweating scenario, okay, by closely watching the price action. You set the take profit order and you eliminate, in a sense, this all hustle, this all shenanigan, okay. So in a sense, it gives you peace of mind, okay. It also minimizes greedy and impulsive, but also over optimistic decisions. For example, again, you set your take profit order at $84 and price action moves to high ground, it moves closer to 84. For example, it's 83.50, and you say, you know what, this thing is going to go even further than that, and I'm going to adjust and modify the take profit order to high ground. Okay, it's an endless cycle of greediness, okay, that is, in a sense, tamed by using a take profit order. You can use a take profit order, and again, avoid doing this kind of scenario of all the time adjusting higher your targets and in a sense impeding your scenario of coming into fruition and not making the amount of money you have desired since your first assessment. Okay, so it also forces you to set a target and stick to the plan, which is the important point in my estimation. Again, start from analyzing how the whole thing is behaving, whatever instrument you're looking at. You make your best case scenario, okay? You set your projections, you set your take profit orders, and you stick and stay disciplined and watch your plan being carried out. If it does not go where you have expected to go, fine, okay? This is a common theme when trading in the markets, okay? The whole thing does not match your expectations all the time, okay? But if you have a solid assessment, if you have different indications giving you much more confidence that, you know what, it's going to hit the target I just met, okay? Using take profit orders makes you or forces you to stick to your plan, okay? And seeing your plan being carried out to the T, okay? So it cultivates discipline, which is another complementary advantage that comes from using take profits. Okay, so there are numerous benefits at using take profit orders, but the point is, you use them for the peace of mind, because trading is actually a very stressful. If you have been doing this for quite some time now, you will realize that this is super stressful, and you need to put in place the necessary mechanisms and techniques that will allow you, okay, not to be stressed all the time, and again, have peace of mind, and okay, being focused on how you can analyze correctly and set your case and then execute upon it, okay, rather than just blindly opening a position and being fixated on a price action up and down, and you sweating in front of the PC. No need to do that. You cannot, obviously you can do that for the foreseeable future, but it's not in your own benefit. So why not use a take profit order? If it goes there and you cash, perfect. If not, you use your stop losses to minimize your loss, okay, which is a segue to the next topic, which is going to be about stop losses. But before we go into that, let's see what we mean take profit and stop loss orders. In this kind of case, it's going to be just take profit on a visualized kind of manner. Okay, so you have a slide here showcasing you how to visualize the take profit. You have a price action of what? Gold, 1 hour chart. Okay, so the green line here down there with the green arrow indicates the opening, the initiation of the position. You can clearly see it here with the hashtag and its number. Okay, we said buy one lot of gold, okay? And given the price action here, without doing any technical analysis on the whole thing, we just set blindly a take profit order at the most recent peak, which is at 1890 level, so 1890 level, okay? So what can you tell from visualizing take profits? The order is always below your take profit target. If it's above it, okay, if the take profit is below your open order, it's definitely not a take profit. It's most likely a stop loss, okay? So a principle you can observe by only this screenshot here is that the take profit is always higher than the open position at the initiation of your trade, okay? Again, pretty self-explanatory stuff, but still, this serves as a visualization tool, okay? For learning purposes, obviously. Okay, so stop loss orders, same thing. What is a stop loss order? So a stop loss order is in a sense the opposite of a take profit. Okay, the stop loss order is an order to buy or sell a specific instrument once it reaches a certain price. So a pending order in a sense, because it uses that, you need that specific level in order to trigger that stop loss, which is a type of order, which is called a limit order. Okay, so a stop loss is designed to limit an investor's loss or a position. This is why we use stop loss orders. For example, setting a stop loss order 5% below a price at which you bought the instrument will limit your loss to 5% and only 5%. That's it. You predetermine the level that you are comfortable at losing money at if your current assessment fails to be carried out, and you make a deal with yourself that if the price action turns to lower ground, if you had an open position going long, okay, I will minimize my loss at this kind of level. Obviously, it's subjective. You could have set up your stop loss order 1, 2, 3, 10% below your open price. It depends on your trading style. Okay, but the point is, you set a price and you commit to that level where you say, if my assessment does not go my way, I'm willing to take a small loss rather than hold the position and have a much more devastating loss at this specific level, and I'm gonna see it through. I'm gonna lose money because it didn't go my way, and I'm gonna carry onwards with marginal and small gains. That is why you use stop losses. Now, let's assume that you just place a long order buying WTI at $80 per barrel. Okay, right after buying the commodity, you place a stop loss order at the $76 level. Okay, again, subjective to your own liking. Might be at the 78, might be at the 79. Depends on your horizon as well as your risk tolerance. Now, if WTI falls below the $76 level, your position will be terminated. Your system will automatically close your position, okay? And you're going to have, in a sense, a small loss, but still, you will minimize your excess losses, okay? And this execution will take at the prevailing market price you just selected, again, and you realize in this kind of case a 5% loss. Now, the advantages are pretty much the same as the take profit, obviously, because it's the inverse of the take profit. So it's easy to place and modify, that's a certainty. Protects traders from unexpected volatile movements. And if you've been long enough in this game, you see there is a lot of them out there. Okay, for example, later on today, we're going to have the release of the latest non-farm payrolls report from the United States from the month of November. If you've been doing this for quite some time now, you will know that NFP is one of, if not the most volatile releases that are out there in the market. And it's definitely guaranteed that you're going to get some sort of volatility, either going with you, okay, going in favor of you, or on the flip side against you. Okay, so by using stop losses, stop losses protect traders from unexpected volatile movements. For example, if WTI or gold prices fall sharply okay, after a superb NFP print, okay, and you set your stop loss at 2% lower than your open price, and gold drops, I don't know, by 6, 7, 8%. Again, this is an extreme move. You will get guaranteed a small loss of 2% and not the 6, 7, 8%. Okay, this is in a sense what the stop loss is protecting you from excess volatile movements. Now, it also once again provides peace of mind for traders. Again, setting that level and seeing it through. Okay, and you can place take profit and stop loss orders and then carry on doing something else, analyzing a different instrument rather than just being glued on your screen. That's something that that is a convenience that is provided by using stop losses. Okay, also it minimizes impulsive greedy decisions or over optimistic hopeful situations, pretty much like the same thing that the take profit does. It enforces you to make peace with losses and understand they are part of the game. This is the most crucial aspect, or at least the key takeaway from the whole presentation so far in regards to stop losses, which is this forces you to make peace with losses and understand they are part of the game. You will never get 100% of the time the market going your way and you making 100% of the times you trade, okay, making money. Okay, it's borderline impossible. I personally haven't seen anyone that has a proven track record of 100% of placing orders. If you find someone out there like that, please send him my way. I would like to study his strategy and his techniques. But still, the point here is to become familiar with the aspect of losing. I know it sounds contradictory, but you need to sacrifice small losses rather than complete blowouts of your accounts. So stop losses allow you to stay longer in the game, learn from your mistakes, and move forward rather than not placing stop losses. Bet all your money on a specific instrument. It goes the opposite way and you end up burning up your account. Why do that? It's no sophistication in going trading like this. Okay, risk management is the most important aspect of trading in my own from my own biased point of view. Okay, no matter how good you are at interpreting technical indications and signals and reading the markets and reading fundamental news and understanding how it impacts prices of specific instruments, if you don't have proper risk management techniques, you will not stay in the game long enough to make money and become financially free, as they call these days. Okay, so it also, the last point, and we're going to move on to a live environment, I think. Okay, it also indirectly cultivates discipline. Okay, you set your target, you have it there in front of your eyes, you place it there, you make peace with yourself that, you know what, if it doesn't go my way, I'm gonna have small losses. You do that, you see it being carried through, and you move forward. Okay, so it cultivates discipline. Okay, and eliminates, or at least minimizes, erratic kind of behaviors where you have a lot of things on your plate and you just become overwhelmed and you don't know what you're doing and you start losing excessive sums of money. So stop losses prevent you from ending up like that. Okay, so a quick visualization of stop losses, pretty much the same thing as we saw earlier on with take profits. The key principle that you have to observe here is that you have the open position there, you have a long order there. Okay, you assume that the price action is going to rise to a higher ground, but if it doesn't, you are willing to exit the position at the 1,870 level, because that's the level, that's the subjective level you have chosen yourself to set as a stop loss order. Okay, I'm willing to lose what, $10 on this, $10 or pellet on this kind of trade. Okay, if it goes the other way. Okay, if the whole thing gets flipped on its head, I'm willing to lose only $10, and that's where I'm setting my stop losses. That could have easily been down here at the bottom at the 1,860 level. Again, it depends on your risk tolerance. It depends on your trading horizon, on your type, or what kind of what type of trader are you, and many different things. The point here is that stop losses always are going to be found below the open price of your orders. Okay, flip side can also be true for when you short the position. So if you sell, when the initiation of your trade has a sell direction, okay, so you're shorting something, the stop loss is going to be obviously above it, and the take profit is going to be obviously below it. Okay, so again, pretty self-explanatory stuff. Enough about this. Moving on to the risk reward ratio, another key assessment tool or risk management tool that successful traders use before they make a trade. Okay, so it's in a sense, this is a question of how much money I'm willing to earn compared to how much money I'm willing to lose. This is pretty much the risk reward ratio. This is what it encapsulates, and you will see it gives you numerical values, but you will understand what I mean shortly. Okay, what is the risk reward ratio? The risk reward ratio marks the potential reward, okay, an investor can earn for every dollar they risk on an investment. Okay, so I'm willing to bet $1, okay, on Euro USD, and I'm willing to make, okay, $4. So that's it. I'm risking $1. I'm having an output of 4. So 1 is a 4-to-1 kind of risk reward ratio. Now, many investors use risk reward ratios to compare the what they expect to earn from investing with the amount of risk they must undertake to earn these results. Okay, so a setup with a risk reward ratio of 1-to-3 or 3-to-1, whatever the way you're going to see it, suggests that an investor is willing to risk $1 for the prospect of earning 3. Okay, so the higher the risk reward ratio, the more money you expect to receive from betting $1. Okay, so traders often use this approach to plan which trades to take, because even if you find one attractive position, okay, you see a movement that you see, you know what, it's going to move to higher ground, I have high confidence in this kind of scenario, you at the end of the day need to assess whether it is worth getting into that trade. Okay, so this is why you use the risk reward ratio. It doesn't mean because you feel 100% sure it's going to move to a higher ground that you need to undertake that trade. Okay, it must bring the highest form of reward in your assessment in order to enter that trade, rather than just blindly entering a trade for the sake of it. Okay, because it fits your narrative. Okay, so it's a nice way of approaching, okay, trading. Okay, for example, having a risk reward ratio of 2.5 to 3 and above it, okay, in my assessment, in my own personal theory, worldview, I feel confident at entering a trade. If it's below that, I don't bother enter that trade. Okay, I know people that don't get out of bed to trade once if the risk reward ratio is not higher than 4. That's their let's just say personal bias, or that's their own preference. Okay, I know people that risk trade, the risk going into trade with a risk reward ratio of 2. Okay, it depends upon the individual. Okay, if it's not willing to get into that trade and stress and being glued on my screen and seeing all that kind of stuff, don't take the trade. Okay, find the risk reward ratio that is in your own personal self-interest. Okay, and adopt that into your trading strategy. Okay, Again, that's another way of going at trading. Okay. Now, traders often use this approach to plan which trades to take, and the risk and the ratio is calculated by dividing the amount a trader stands to lose if the price of an asset moves in an unexpected direction, okay, which is what we call the risk parameter, by the amount of profit the trader expects to have made if the position is closed, which is what we call the reward. Okay, how much money you're willing to make compared to how much money you were willing to lose. This is the risk reward ratio. Now, the difference between the market price and these 2 points, the take profit and the stop loss, okay, helps define the trade's risk to reward ratio. Okay, so for example, you enter a long position on a stock at $100. You aim to make $10 on this trade. So if prices reaches the $110 range, you execute. Okay, you get an execution, you get a close. Whereas you're willing to lose $4 on this kind of trade if the stock doesn't move as you expect. So in a sense, place a stop loss order at the $96 range. So you have a take profit at 110, you have an open position at 100, and you have a stop loss at 96. Okay, so therefore, based on your expectations, the risk ratio is 1, or what we call 2.5 to 1, or 1 to 2.5, whatever that may be. Okay, so you're willing to lose, you're willing to risk losing 4 with a prospect of earning 10. Okay, this is the risk reward ratio. We're gonna see this in action right now. Okay, so give me 1 sec. So what do we have here? Let's see, what instrument is this? EU50. So we're talking about Euro Stocks 50. What is this? I have already made some plans on this. Okay, so this is European stock market, what we call the Euro Stocks index, the Euro Stocks 50 index. Okay, has the 50 largest stocks of the European markets. And as you can see from this chart, this is the technical analysis I've made on this particular instrument. If I'm not mistaken, we released this report with fundamentals and technicals on 2 days ago, on Wednesday. You can find that on the website. You can read through the whole thing. Okay, explains how the whole thing, what are the projections given this kind of trade. You can read it out your own time. But let's do gold. Okay, so we have a chart here that we have not worked upon. Let's do that together. So gold futures on what, daily chart? Yeah. Okay, let's do our base case scenario assessment, all that kind of lovely stuff, and we'll at the end of the day calculate, we put in practice take profit, stop loss order, and calculate or come up with a valid risk reward ratio for our trade. Okay, so let's do a quick technical analysis on this with all the stuff we've learned so far. Let's apply trend lines. Let's apply support and resistance levels. Let's do why not do Fibonacci? We can do Fibonacci, and you can clearly see on the chart right now that we have Bollinger Bands, we have moving averages, a short and a long moving average. We have down here RSI and MACD. We have a plethora of different technical indicators. Let's put them all together. Okay, so as you just saw, I've drawn a lovely ascending trend line. Okay, fitting nicely at the bottoms of the higher lows, the consecutive higher lows. Where is that drawing to? That's one. Okay, brush, whatever, I don't care. So that's one. That's a higher low, and that's another one right here. And we currently see the price action attempting to form some sort of higher low here. Pretty soon to tell. And always we have to keep at the back of our minds that NFP is approaching quickly in what, few hours time. Okay, so again, our assessment will be a little bit more biased, and I don't know if we're going to come up with a projection prior to NFP, because NFPs, as I just mentioned in the presentation, has the prospect of distorting and demolishing price action, okay, demolishing stop losses and take profits, depending on the result. So again, we're playing with fire here once we do technical analysis on gold today, especially. Okay, so that goes without saying that we have also we've highlighted the higher lows. Let's highlight the higher peaks. Clearly see them there. You can do this right here or up there. This is an all-time high, by the way, at what, $2,146 of gold. High volatility in here, maybe because from a technical point of view, traders saw this level as a, let me get this out of the way, as a technical breakout. So we have, let me, we do like this. Definitely this level is crucial. Okay, so this has been the prior all-time high for gold, which was formed, when was this? Back in August of 2020. Okay, somewhere around the vicinity of $2,075. Okay, so that's certainly an area that we'll be paying close attention to. You see prior peak at March, early March of 2022, closing in that level, failed to break definitively above it. You see another test and a break here, but failure to close above that level. Certainly we have 1, 2, 3 attempts of breaking above it and the failure to do so. This one is no bloody different. Okay, so let me remove this gibberish out of here. You see, open up there, down there, open down here, close up there, open here, rally up there, but failure, okay, to close above this key level. So that's certainly an area of strong resistance that I will be paying close attention to. Okay, so open price here, went up there, and then closed down here. Definitely an indication of strong resistance forces. Okay, the bears are piling up in this area and they are eager to push the price action to lower ground. They do not want to see the bulls pushing to higher ground. Still, we will see. Okay, definitely an area that we'll be paying close attention to. What else can we see from here? What about support levels? This is definitely a support level in my eyes that is going to be crucial in the next movements of gold. Okay, so coincides with a lovely, a former higher low, higher high. Okay, this peaking here and then rebounding from, attempting to form this kind of lovely cup, this lovely consolidation, this level. If we go further back, we're probably going to find some sort of other areas of stalling. Okay, but for that, for the time being, that it's sufficient. Another area is definitely this. Okay, again, coincides with the higher low, prior peak, once, twice, break, relatively speaking, nicely above this level, but still found some sort of support and rebounded from. Definitely an area that we'll be paying close attention to. And the last one, we could place it down here, okay, given this, but I'm going to also place it much more closer than that, somewhere in here. Okay, so these are some arbitrary support and resistance level or areas that we'll be paying close attention to if the price action fails to break above it, okay, and move to lower ground. Okay, let's also do, what can we apply to your charts? Let's do Fibonacci retracement. So taking from the top to the bottom. Okay. So we have the complete reversal of the move. So we see the peak, we see retracement, we see, okay, rebound, strong rebound, and the completion of these kind of moves. So we went from 0 to 100 to 0 once again, or 100 to 0 and 100, okay, depending on where you're looking at. Okay, so how does this kind of Fibonacci retracement tool alter our assessment or gives us much more confidence in regards to support and resistance levels? So an area that nicely coincides with this, with our pre-selected support levels, is the 50 area. Okay, no surprises there. How about the 61.8%? Drawing conclusions from here, definitely, I don't know how we missed this, but we did. Okay, support, rebound, failure to break above it at this kind of level, second failure to break above this level, rebound from here. Okay, so that's certainly another area that we have to highlight. Okay, and I'm gonna draw this lovely trend line here. I'm gonna place it here. Okay, 61.8, mainly because it has also some sort of significant to in the eyes of traders that use Fibonacci. Okay, I'm not one of them, but still I respect and I acknowledge their biases. Okay, what about another one close to the 23.6 level? Okay, it's a little bit higher than that, but still an area that we'll be paying close attention to. And the 38.2, we have some sort of stalling in these kind of levels. Again, a valid level that we'll be paying attention to. However, the reason why I'm not going to be drawing any support levels below that is because the current trajectory of the market is definitely, of gold prices, is definitely tilted on the bullish side. You can clearly see that from the ascending trend line. You can clearly see it by it's challenging to break above and reach territory once seen before in Nevo. So it's an all-time high territory. So you can clearly see that the highest it went, okay, on, when was this, last Friday or early this week? So it went there on Friday, but early Monday morning we see gold hitting all-time highs, and it went as far as the 1.27.2 level. The 127.2 coincides perfectly with the Fibonacci extension, okay, of this particular move. Okay, again, coincidence. So we see peaking there and retracing sharply after that back below the 100%. Okay, so, and we see currently forming a base at the 78.6 level. That level is not that important in my eyes. I pay much more attention to 61.8, definitely the 50, and sometimes either the 38.2 or the 23.6. Again, that's my own personal bias. Doesn't mean that these levels shall be yours. The only level that we agree to disagree that is not important is the 61.8. That's definitely the most important one for me. Okay, and for Fibonacci traders in general. Okay. Also, the 127.2 is the other level. Okay, so what is the data? What is the technical indications telling me? Okay, what is this line here? I don't know why this is there, but still. Yeah, okay. So what is our positioning? What is our analysis? What is our bias on this kind of case? Looking at this, we are in dire straits in regards to gold, but we have to draw some sort of conclusion. Definitely, I say I interpret these kind of indications as bullish. Okay, clearly from this and the formation or the attempt or consolidating above this kind of level. Okay, a higher low. Okay, close to the prior peak of the former higher low, higher high, excuse me, it's definitely a nice indication that the bulls are not completely out of the picture and they are eager at pushing price action to higher ground. However, looking at individual candlesticks here on a daily chart, I don't know about this. I don't see enough volume or enough strength of the bulls, but the fact they are actually consolidating and they're not leaving matters in the hands of the bears is giving me some sort of given indication that they may be attempting to break above this. I'm extrapolating, okay, that they are sitting patiently behind their monitors, are waiting for the NFP result. And if the NFP result is worse than expected, so the current expectation, I think we have the forecasts here. No, we don't. If I remember correctly, we have an expectation for a rise of the NFP figure from the 150 to the 180,000. Okay, that gives you an indication that shall that be the case, we may see strengthening of the United States dollar, and on the contrary, we expect to see pressure, okay, mounting on gold. If, however, we see a number of NFP of 180, okay, below 180, close to the 150, and even below that, okay, we will have much more confidence in our assessment that gold will rise, mainly because it's going to capitalize on the dollar's weakness. Because if we get an NFP result worse than expectations, okay, severely worse than expectations, that will impact the trajectory of the dollar. It will push it to lower ground, because this will give us, it will draw a picture that the US labor market is having trouble at creating new jobs, and we may see fears for a possible downturn in the labor market capabilities at creating new jobs. And if we also see the unemployment rate rising higher than the 3.9%, for example, to the 4.2, 4.3%, even, again, an extreme scenario, we may see an even much more bullish case for gold, because we will reasonably expect to see the United States dollar fall. Okay, so it's definitely dependent upon the fundamental data that is coming out from NFP quite shortly. So looking at technicals purely without having that extra knowledge in regards to fundamentals, this kind of picture that is drawn in front of our eyes right here is definitely on the bullish side for gold, okay? Because we have a crossover. Let's list the things that are giving us confidence in our bullish scenario. Definitely the crossover right here, okay? So a short-term moving average, okay, the yellow line or the gold line, whatever that is, crosses above, okay, the black line, which is the long-term moving average, okay? So this is what we call a bullish crossover, and you can clearly see the lines drawing further apart, not, okay, crossing over in this kind of period. Mainly because we have superb bullish sentiment behind gold prices, okay? And we see still the lines being further apart, even after this kind of correction. Also, what else do we see? Bollinger Bands, we see the price action, okay, breaking violently above the upper bound of the Bollinger Band, and the market quickly, okay, and the bears quickly entering the picture and correcting this over exuberant, okay, this super strong bullish move, okay, bringing them back to below the upper bound of the Bollinger Band and within bounds of the upper bound, between the two bounds of the Bollinger Bands, okay? And we also see the price action. If you can clearly see, let me move this out of the way, and you can clearly see the midline of the Bollinger Bands. Let me highlight it even further, okay? You can clearly see the blue line. You see the price action, okay, staying still above the upper bound of the Bollinger Band, the midline of the Bollinger Bands, giving you another indication that the sentiment still lies with the bull. Yes, it has been tamed, okay, since the bears entered the picture and draw and made this kind of correction after this abrupt move, but still it's above the mid-level of the Bollinger Band, still telling you that it's in favor of the bulls. This move is still in favor of the bulls. Okay, so let me restore it back to what it was. Okay, what else? You also see consolidation being formed around the 78.6 level. Again, not that much of confidence can be given from this level, but still it's a formation above a level used by many Fibonacci traders, technical, that use this kind of technical indicator. What about moving average, convergence and divergence? MACD is definitely on positive territory, as we just mentioned. Look at the let me highlight it. Look at the zero line. Okay, let me bolden it. Okay, so sentiment is definitely in bullish territory. It's above the threshold level. Okay, this is what we call the zero line. Okay, it came from negative territory into positive territory, and it's forming a base, okay, in the positives, definitely giving you an indication that the bulls are in control. What else we can see from this? Let me restore this back to normal. Okay, we see the crossover taking place near the level we just saw with the moving averages. Okay, the crossover with moving averages. We see another cross there. Okay, after a small correction. Okay, and we see currently the price action being currently the MACD line attempting to cross below the signal line, which is going to be an indication that, you know what, the bears are indeed taking the initiative. However, we can see them now. Okay, it has crossed below it, but still they are relatively super close to each other. They are flirting with each other. So this is the signal that gives us, that leads us to assess the strength of the momentum, the bullish momentum. Okay, we see it kind of flattening, and we see maybe we could see a pivot or a switch. Okay, with the bears entering the picture and driving the price action to lower ground. So this is sort of, or can we classify it as an indifferent kind of indication? This is the one that does not give us indication that it's bullish or bearish. Currently doesn't say much. What about RSI? The RSI is this lovely purple line here. Let me highlight it. You can clearly see it. After breaking above the 70 threshold, which is this excessive move, it has returned sharply to lower ground, but still, if I'm not mistaken, is above the 50 threshold, which is RSI middle band. No, we don't care about this. Overbought is up there. Where is the setting for this? Sorry. The scale is on the left-hand side. That's why I cannot see it. I've been looking at it. You can clearly see that the RSI, or the regular RSI, not the RSI based on moving average, has a value of what? 58, still in positive territory, and we see it rebounding, okay, from this level, from this 50, okay, and stays in positive territory. Again, another bullish sign. So we have a plethora of bullish signs, but also we have to keep on the back of our minds that the MACD indicator may be foretelling that it's going to be a possible shift in direction. Okay, so we have what, 5, 6, 7 bullish signals and one that is sort of indifferent. So our assessment mainly lies with the bullish case. Okay, But another negative signal in our assessment is this fierce resistance area, as we expect to find some sort of severe resistance from. Okay, however, taking all of this with a grain of salt, we have a long bias on this, so let's just say a long position, and this is super hubristic or super optimistic from us to do this kind of thing on NFP Friday day. You will see what I mean if you pay attention in a few hours time, what's going to happen with gold if we get unexpected results. But still, let's finish off this example. Target is much more likely going to be somewhere in there, assuming that it's going to have a sharp rise and definitive break above this kind of resistance area. Support level, where would my stop loss be? I would set it somewhere below this former peak. Okay, so we have a risk reward ratio of 4. Super nice, but still we're talking about having over optimistic projections about an instrument that has been overextending itself over the past, since October, so 1.5 months in the past. Okay, so we have to be super cautious in regards to this, not only purely based on the move, but also because, again, it's NFP Friday. Okay, so this is purely our assessment using only fundamentals. Okay, excuse me, only technicals, not including fundamentals into the picture. Okay, so this is one way of doing the whole thing. So once again, stop loss is going to be set at, let me draw some lines for convenience. Let's just say this level, which is the 2000, let me make it, I don't know, black. Let's go with black, which is it's going to tell us right here. Let me zoom in a little bit. What level is this? The 2000, approximately $2,000 range. Okay, and take profit is going to be much higher than that at the 2040. Okay, 2,140 the level. Okay, dollars in regards to gold. Okay, so I'm willing to keep the position open to see it be my take profit being hit at this kind of level, but I'm willing to earn as much as that, which is how much? Let me see. Let's assume that we open the position here. Willing to make 5.5%. Okay. I'm willing to lose what? If it goes the other way, 1.15, a little bit more than that. Let's just say 122. So that gives you, as the tool right here tells us, a risk reward ratio of 4. Okay. So that is how you go at placing take profit and stop loss orders using the risk reward ratio as well, implementing your assessment, okay, making this base case scenario, interpreting what the technical indicators are telling us, drawing support and resistance levels, drawing trend lines, drawing Fibonacci retracement and extension tools and all that kind of lovely stuff. MACD, RSI, we've done all of them together. You saw me rationalize as we added more stuff to it. You saw me interpreting these kind of technical indications on the fly. The point here is learn to do a much similar process when you go at trading, rather than just blindly saying, oh, you know what, I see gold futures near all-time highs. I like this. I'm going to open a long order without paying any attention to what's going on, or placing a short order just because I see it reached all-time highs. Okay. Equally valid, but you need to have a reasoning behind your actions. That's what I mean. Okay. Make a case and see it through. Take profit, use stop loss, okay, orders to cover your bottom if it goes the other way. If it goes the other way, I've lost 1.2%. Okay, fair enough. Moving onwards. Okay, if it goes my way, I bank. Okay, and that's pretty much how you can use the same kind of rationalizing thought, okay, while going out your own trading journey. Okay, so enough me blabbering. We have reached our limits for today in regards to time. Again, this has been the end not only of this webinar, guys. This has been the end of this series. Hope you have enjoyed this kind of content. If you have any, I don't know, ideas of what else you would like to see in this coming webinars that are going to start in January, please send me an email. Okay, I want to see this, blah, 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 blah. I want to see that, blah, 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 or I want to see more live trading sessions together, whatever that might be. Please send your suggestions. Okay, I will do my best to create some sort of content in regards to your needs. Okay, so for the time being, I have to salute you. Hope you have some a lovely weekend, okay, and a lovely Christmas and New Year's times. See you next year. Okay, take care. Bye bye.